Our next guest says stocks may continue to climb this year, but he's more bullish on the less loved names, the value stocks that trailed the rest of the market last year. Hedge fund manager Lloyd Khaner runs Capital Management. I want to welcome back Lloyd to the program. Good to see you. Happy New Year.
Happy New Year. Good to see you, John.
So do you still find yourself as a stock market bull after the market run-up that we've already seen?
Yeah, we're still bullish. I think in a single word for this year, probably higher. Just because profitability is good, corporate operating margins could hit historic highs, and if the market multiple holds just where it is right now, by the end of the year we should be higher. That said, there are macro risks.
Okay, let's explain that story. So right now, the big Wall Street strategists are looking for, on average, the S&P to make something like $92, $93 a share. So you crunch the numbers, and that would suggest the market's trading maybe around 14, a little less, 14 times its expected earnings. So is that cheap? I mean, what is a good deal?
I think that it's not expensive historically. I wouldn't necessarily call it cheap. You know, March 2009 was cheap.
Right.
It was scary, but it was cheap. So, but within that, there are companies that are still inexpensive on a multiple basis.
You can find stocks in the Dow that underperformed last year. Stocks like HP, Microsoft, Merck, trading below 12 times their estimates. One stock that you like as a value stock for this year is Xerox. Why do you like Xerox?
Well, Xerox is kind of not your father's copier company. It's a business solution.
Not as exciting as Facebook, I guess.
No, not nearly as exciting, and probably never will be. But it was a turnaround that was done well by Anne Mulcahy, passed on to Ursula Burns, worked her way up the company, and now it's inexpensive at less than 11 times earnings with a lot of cash, pay down debt, increase their dividend probably later this year, buy back stock, growing earnings 15 to 20%, selling at less than 11 times. Cheap.
You're a value guy, but you also like gold. And the last time you were here was in the summer. Gold was trading around $11.65 an ounce. You thought over the next 12 months it might double. Here we are, the move up about 20% since then. Do you still think we could see gold move above $2,000?
I still think it could, you know, based on hedging inflation, hedging currencies, and just basic fear. That being said, if gold underperforms this year, though long term I think it moves a lot higher. If it underperforms this year, it's because those concerns are lessened. That being said, the gold mining companies should do very well because even if gold holds here or drops a bit, their profitability is now exploding.
And you still like 5 or 10% of your portfolio in gold? Is that how you play?
Absolutely.
And the gold mining companies, we know that they, in a way to attract some investor money away from some of the popular ETFs, have boosted their dividends.
Yep.
Is that a trend you think will continue? Is that a reason to own gold stocks over ETFs?
Yeah, I think that's one good reason. And like I said, I think profitability at these companies, you know, if they're taking it out of the ground and it costs $400 to up to $1,000 an ounce, and they're getting paid anywhere from $1,300, $1,400 an ounce, their bottom line earnings are going to start growing a lot now.
Lloyd, explain how much things have changed over the last couple of years with people being very cost conscious and how that has helped this industry.
Yeah, there's been a big change. It started with the companies themselves about 10 years ago. They really improved their quality. But now as people are looking to save money, buy products the same quality as branded, they've been shifting, and I think it's going to continue.
The difference is minimal, but the price is different.
The price is about, you know, the quality difference could be, you know, minimal if not nothing, and the price difference is about 30% on average.
Now, the difference between the U.S. market and the European market is that people have been more willing to buy private label stuff in Europe for a longer period of time, whereas here people still like their brands a lot.
Oh, absolutely. Europe and other parts of the world are over 40% of their shopping basket in private label, where in the United States we're about 20%. So we've got a long way to go.
One of the stocks that you own is Treehouse Foods. It's up about 30% in the last 12 months. They make all sorts of stuff. They make mac and cheese, soup, salad dressing, oatmeal. What is so special about Treehouse?
Well, first and foremost, it's the management team. It's led by Sam Reed, who's the chairman, CEO, and his team with Dennis Vermillion and Dennis Reardon. They were ahead of the curve on private label. They saw it coming. They got some Dean Food assets. They turned them around, used the cash flow to buy other private label companies, and they work well with retailers and tell them how they can save money and make money by using private label foods.
That's one that you own. One that you don't own is Corp, which for the longest time was just focused on cereal. They did a deal, bulk up a little bit, but what's the difference between these two names?
Well, recently they bought American Italian Pasta, which they're integrating. It's seemingly going well so far, but they're mostly cereal, and basically they need better pricing on cereal for their company and for the industry, for the branded as well. They've got excellent management also.
And what about the whole commodity craze and what that does to these players? Even if they can attract more consumers because their prices are good, what about their own costs?
It's tough. They keep going up. That's why they really need pricing. Again, the brandeds need it in cereal as well as the private label, so they're like likely going to get it this year, but they need to raise prices, I don't know, 2, 3, 5% this year just to keep up, and then probably take a little bit for their bottom line, which I think they'll probably get.
Very quickly before we go, what about the big branded companies? I mean, are you an investor in those companies too, or do you feel like, no, these private label players are stealing the show?
Right now, no, but they might do very well this year if they get the pricing as well. So I don't think they're going to steal the show quite as much as they did before. I think they all could win this year.
All right, Lloyd, thanks for your time. Happy
Pleasure.
New Year.
Happy New Year.
Lloyd Khaner of Khaner Capital Management joining us.